Now, the PBOC implemented silver export controls, and they're in effect in mainland China. And while these same four LPMCL clearing members are able to access offshore CNH future silver from the western facing Shanghai Gold Exchange international hubs, the bullion is also being competitively bid to fulfill other global shortages, further tightening supply. Everyone wants silver. So while these inadequate LPMCL US and China shipments may have brought some temporary default relief, the net solution to avoid default is for these silver cartel members to buy back large, unallocated silver exposure with physical at higher market prices. What we're witnessing is an at all cost protection of the officially held COMEX LBMA OCC bets against silver futures breaching very large short stops that have only just begun to be tripped off above the May 1st, 2011 50 highs, which was here. And notice that the pullbacks have come back to this level. Now these stops, the further up you get here, these stops will ignite, can really risk igniting, and ultimately will spiral into an out of control disconnect versus the globally determined spot silver benchmarks. Very short term, we assessed in our last episode and in the prior ones, while we expect 53 to be the next rally staging liquidity providers assess $140 silver would provide the most likely staging point to bring sufficient bullion to market, and it will require sufficient bullion to come to market for the for the short covering to be completed. Now, we were looking at futures, but in the spot market, the real spot market, which is basically driven by every single other currency, FX currency in silver, making all-time fresh highs, we have indeed seen silver testing the 53s, the mid 53s. And it's really this EFP spread, which we're sort of looking at and going to explain better, that is causing this disconnect. Here's a quick example of silver in offshore in the SGEI exchange, the offshore Chinese exchange. And while I'm looking at also gold. So as is evidenced by the unprecedented full spectrum backwardation into as deep as July 2028, mind-boggling, you have to look at it to believe it, and it's improved somewhat, but this is a broken market. And as we assessed last time, even into the 1979 to 1980 Hunt Brothers short squeeze, these sort of backwardations did not exist. And whereas the Hunt Brothers backwardations were able to be contained and cash settled inside the siloed COMEX, where essentially that's where the market was, now the price-taking physical liquidity has been captured by the Western-facing SGEI physical exchanges, influencing every other silver and gold foreign exchange cross. And as we previously ascertained, the quarterly OCC reports, the Office of the Comptroller reports, lists the historically accrued, unallocated, unbacked foreign exchange silver derivative bets being stick-handled for the Fed by the two remaining Fed agent banks, JP Morgan and Citi. Now, do you remember we showed the third quarter unwind of the 5-year derivative bets? That was an important point to note. But actually, out of the 4 LPMCL members, that's ICBC, Standard Bank, JP Morgan, UBS, and obviously, so basically, it's only JP Morgan that provides the only LPMCL cartel member that provides the conduit into the OCC derivative bets. So, you know, ICBC, Standard Banks, UBS, and JP Morgan. Now, notably, and by absolutely no coincidence, last week's rushed together proposed OCC rule, there was a rule change. It slipped under the radar. Now, the CME finally raised their gold and silver margins, respectively, from 17,000 to 18,000, and in silver from 16 to 17,500. Now, by last Friday's London Open, lease rates to borrow silver to meet immediate delivery demand spiked way north of 24%. We're using 24%, but it was actually over 30%, driving the silver short squeeze EFP basis spreads that we just talked about. And here we captured it here live at a huge $2.80. That's $14,000 per contract difference. In fact, it has been as high as $3 or $15,000 per contract. Now, the expanded basis spread misplaces the spot equivalent fix. So to illustrate, we spot adjust it in and demonstrate it in green at the fix hours. And as you can see, it is substantially higher than the COMEX, where we actually place the equivalent COMEX fix. At the peak, we captured these unprecedented futures backwardations extending all the way through to July 2028. This is mind-boggling. It's unprecedented. It illustrated mispricing COMEX silver market futures are completely broken. The market's broken. Whereas in real time, we're evidencing the SGE-centric, physically settled global spot markets shaking this COMEX tail. It's amazing to me that how few people have actually woken up to this huge breaking of the COMEX. In fact, the SGEI silver prices are setting local London spot prices consistently, one-to-one, mirroring the fresh highs in spot silver as well as gold. And in short, the unprecedented supply constraints, there is hoarding alongside strategic positioning around critical minerals leading to global export controls, have left London silver cupboards absolutely bare. Now, worse, unallocated, undeliverable local London FX obligations that had been so-called hedging these COMEX short positions. So when they're called on for physical delivery, these bets in London, these bets are impossible to cover into globally driven, higher physical priced demand. And what it's done is exposed these asymmetrically mismatched LBMA CME derivative bets as naked. Now, these bets are being called in. That's what's happening, threatening default if they're not brought back at higher prices, further tightening supply. Now, these global physical shortages have spilled out into all global exchanges, as exampled by India's Kotak Mahindra haltering ETF investments, as noted here. They were citing a lack of supply at current prices. Since then, UTI, SBI mutual funds, and one others have effectively immediately now suspended fresh subscriptions to their silver ETF fund or funds. You cannot get access to it. London has lost control of the global silver market. We said it last time. It is now so clear it's hard to ignore. Unprecedentedly high risk, unfulfilled local London lease fees illustrate both a lack of trust to lend metal into global supply tightness. So, why you can't trust it? It's too risky. These spreads could be closed at any time. And while registered COMEX inventories appear to be in adequate supply, that is enough to cover a rush of delivery demands, really, as it looks at face value, these leveraged CME warehouse receipts are inequitably hedged against an unfactored lack of local London supply. This is why lower priced US denominated bullion is slow to be shipped out to capitalize on up to a massively, as I say, attractive $15,000 profit per contract. Silver actually should have immediately been flown out last week, last Thursday, last Friday. 160 SI lots would equal 25 tons. You could put those in on a plane for a matter of a few extra cents per ounce. Yet it was very slow to move. And this is really what we're drawing attention to. And while we're evidencing some profiting from shipping US bars to London, and we'll look at why this will not lower the higher spot price to meet the lower futures price. In fact, the opposite is going to happen. So minor short-term volatility aside, it's the record high global spot prices in every single other foreign exchange currency, no matter which one you look at, across the board, spot silver is at record highs, unlike protected or capped US-centric futures silver. It's so obvious, it's mind-boggling that and yet we look at them, listen to Main Street View, I'm on Bloomberg all the time. While they are caught onto gold, they have no idea that the silver market's broken and how undervalued dollar silver is. And that reflects what it is doing is reflecting really the supply shortages, with this effect forcing the US silver prices much higher. The US is the sole outlier and is being targeted. And while the LBMA clearing members are facing default and are really racing to fly out what little silver bullion they can from the COMEX registered and eligible stocks into London, this is largely serving to satisfy immediate, unallocated, over-the-counter bets that have been called for delivery into empty local London vaults. It's just really keeping pace, trying to keep pace with an immediate default. Notably, illustrating it takes higher prices to bring silver to market. So it's evident. This basis EFP spread and lease costs, they expand significantly into lower prices. They contract into higher prices, but literally expand significantly into lower prices. Nobody wants to lease this out.